We're going to dive into the falling wedge chart pattern and understand the psychology of buyers and sellers that drives it. First, let's get familiar with what the falling wedge chart pattern actually is. Right after the triangle chart pattern, the falling wedge is regarded as one of the most reliable and powerful bullish patterns, thanks to its high success rate. Let's discuss it in detail, but before we move forward, if you find this content valuable, make sure to hit that like button, and if you're visiting for the first time, don't forget to subscribe and turn on notifications so you never miss any of our new uploads. I'll catch you right after the intro and disclaimer. The falling wedge chart pattern functions in two ways, as both a reversal and a continuation pattern in the market. Let's begin by understanding the continuation pattern. Whenever the market is in a strong uptrend and the price makes a minor correction from its recent swing high, moves slightly downward, and forms a higher low, a falling wedge starts to appear on the chart. After consolidating within this range for a while, the price eventually breaks upward from the pattern and continues its earlier uptrend. This type of falling wedge is known as a trend continuation pattern, where buyers have taken long positions from lower levels. Some of these buyers then book profits, forming a swing high on the chart, leading to a brief price correction. However, since there are more buyers than sellers in the market, the price soon resumes its upward move. To understand this concept more clearly, let's go through an example. This is a 5-minute time frame chart. Here, as soon as the market opens, a strong bearish red candle appears on the chart, but after taking support at lower levels, the price begins to rise and even surpasses the day's high. Facing rejection from higher zones, the price fails to move further up and keeps trying to fall, forming higher lows and lower highs on the chart. When you connect these upper and lower points using two trend lines, you'll notice a falling wedge taking shape, signaling a possible upcoming bullish trend in the market. In this setup, buyers are consistently pushing the price upward, but every time it climbs, sellers push it back down. If you observe carefully, the upper trend line lies below the lower trend line and is steeper, indicating a sharper downward slope. Sellers continue pressing the price from higher levels but fail to break past the previous swing lows. This shows that buyers who entered at lower levels are still holding their positions. If that weren't true, the moment the market moved down after facing resistance, buyers would have panicked and exited, causing a sharp decline. But here, buyers remain stronger, preventing any significant drop. After some time, as the price nears its previous swing low, buyers step in again with fresh buying, creating a strong green candle that breaks out of the falling wedge. As soon as this breakout occurs, some traders enter long positions immediately, but this is considered a risky entry point because, if you look closely, although the breakout candle has formed, it has not closed above the previous swing high. That was the level where sellers last entered the market and attempted to push prices down. Their stop losses will only be triggered once the price goes beyond that point, meaning those sellers are still active in the market. If you want to take an aggressive entry, you can enter partially once the candle closes and add the rest of your position either after a confirmed breakout above the swing high or when the price retraces. The market then trades sideways for a bit and forms a 3 inside-up candlestick pattern, which is a strong bullish signal. You can then enter a long position, placing your stop loss below the pattern's low and aiming for a 1-to-2 risk-to-reward ratio. After some time, the price forms a higher low and successfully hits the target. You'll notice that if we had entered with our full position right above the breakout candle, our stop loss would have been too large, potentially resulting in a loss and a distorted risk-to-reward ratio. That's why it's crucial to manage your entry size and maintain a smaller stop loss where possible, as it can significantly improve trade profitability. However, this doesn't mean you should always keep the stop loss small. You must learn to adjust it according to the chart pattern. Only then can you consistently generate higher profits with lower risk. Now, let's move on to see how the falling wedge pattern behaves as a trend reversal chart pattern. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 10th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500 plus 61% off for pre-bookings before October 10th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. This is a 5-minute time frame chart. Here, after a slight rise during the morning session, the price moves sharply downward, forming lower highs and creating a falling wedge chart pattern. Every time buyers try to push the price higher, sellers step in at upper levels, increasing selling pressure and driving the price down. However, if you observe this chart closely, you'll notice that when sellers push the price lower, large red candles appear. But they fail to close at their lowest points, leaving long lower wicks on these candles. This indicates that sellers are gradually losing strength, which is why the price repeatedly fails to break below its previous lows. Each time the price dips, buyers enter from lower levels, creating several long wick candles on the chart. Still, we cannot take a long trade until the price breaks the pattern with a strong bullish candle and continues upward. Soon after, a strong bullish candle breaks above the wedge and closes higher. At this point, by placing a stop loss below the low of the previous green candle, we can plan a long entry trade with a minimum profit target of 1 to 2. Now, to execute this trade properly, it's important to understand the psychology of buyers and sellers. Initially, sellers who entered early in the move likely made good profits from the sharp decline. As the price approaches its previous low, some of them begin to book profits, leading to a slight pullback upward. At this stage, the sellers who missed the earlier entry opportunities wait for the market to rise a bit, and as soon as it does, new sellers enter the market, pushing the price down once again. However, the price still fails to break its previous low. At this level, most of the fresh sellers have their stop losses placed just above the recent highs. If the price attempts to rise above that zone, these sellers may panic and exit, causing a short covering rally and a fast upward move, often known as stop loss hunting. After a short period, the price surges upward, forming a strong bullish Marubozu candle, hitting the stop losses of all these sellers in one powerful move. In the same way, before entering any trade, it's crucial to understand how to read price action and interpret chart patterns. Only then can you consistently catch these strong market moves. That's it for today, traders. Thanks for watching this video. Growth doesn't always make noise, sometimes it's calm, consistent, and unstoppable. If this video added value to your trading journey, don't forget to tap that like button. And if you're new to the channel, subscribe and turn on the bell icon so you never miss our next update. Keep learning, keep progressing, and keep believing in your path. See you in the next video.